Just with your time. Maybe just setting the stage a little bit. There's been a lot of interesting discussion today with the panels about the potential direction of the industry, technological change, regulatory change, consumer preferences, and a whole bunch of related topics. Likewise, all those same discussions are going on at the investor level, and there's effectively three or more levels of investors. There's folks like this who are investing in businesses and making decisions on a day-to-day basis about where to put their finite CapEx dollars. There's a group of public investors out there, both equity and debt, who are funding the publicly traded companies and trying to make the right decision in terms of total return. And then there's people like Tom on the private side who are making investments across the infrastructure space and in a whole bunch of other different areas as well, but all with the goal of obviously trying to make profitable decisions while dealing with the realities of a changing world. I just bring that up because I think one of the things that you think about is there's so many different markets, there's so many different regulatory regimes, there is no one size fits all when you think about it. And likewise, as you heard today, there are a lot of varied opinions about where the future of the industry is going, ranging from more centralized to less centralized, and that affects a lot of behavior in terms of the investor world. Plus, you may be or may not be surprised to know one of the biggest differences we see, and we sold $9 billion in equity in the first quarter. It was the biggest quarter ever for selling common stock. Tech investors are getting interested in this sector, and they have a very different view about what the future holds than traditional utility investors. And it does lead to a lot of very interesting conversations about where the future might be. But maybe just with that short preamble, we can start, and Pat, maybe you'd lead us off, and then we can just kind of go down the row, if that's all right, and talk a little bit about just at a higher level how you think investor attitudes and perceptions are changing, given some of these other trends that we've been seeing. We talked about urbanization, digitalization, regulatory, but technology is certainly in the mix.
Thanks, John. And I think by way of background, I should just make a couple of disclosures. First of all, today my card says Hydro One, but I am a reformed banker. So most of my career, over 30 years, has been in banking, investment banking. And the other disclosure I have to make is that I've only been at Hydro One for about 6 weeks now. And I'm here today. I'm actually replacing my boss, Mayo Schmidt, who I understand was here last year. And I was in week 2 when he asked if I would replace him on this panel. I said, "Boss, that sounds a little soon to me." And then I called John. He said it was okay. So here I am. So thank you for indulging me. And I do look forward to being part of EEI and learning from all the expertise that's in this room and around the organization. Perhaps I could just kind of talk a little bit about what Hydro One is today, to put it in perspective. And Heather spoke earlier. But those students of history will know that it used to be Ontario Hydro was an integrated transmission distribution company in Ontario. That was split by the government of Ontario in the 90s. And so OPG is generation and Hydro One is transmission and distribution, except mostly for the most populated areas. So it's primarily transmission through the entire province and distribution in rural areas. And to put it in perspective, we have 1.3 million customers and 1.6 million poles. So that kind of tells you something about our density. And that's important because that does inform our strategies and how we think about things. We are roughly 99% regulated in Ontario today. And we just, others, many will know, Bob, you'll know that we're just in the process of acquiring Avista in the Pacific Northwest. So that was announced last summer. Roughly was certainly the biggest transaction that we've ever done. $7 billion, circa $7 billion, and that's in regulatory approval now. It's 5 states, and we expect to close that in the second half of the year. So it's a big change in terms of our platform. The other big change, and this is just a little bit of history, but we completed an IPO in 2015, and so we were transitioning from government ownership into investor-owned utility. Today, the government of Ontario still owns 47.4%, but since 2015, so the IPO, the government sell downs, and the equity we issued to finance Avista, it's just about $8 billion of fresh equity capital in 2.5 years, which even by John's standards of their firm, that's a lot of equity, right, John? In any event, we are making a strategic transformation, and really 3 pillars to the strategy. So one is strengthen the core, and this kind of ties back to a lot of what was talked about in the innovation panel. So strengthen the core, it's drive innovation in the business, and it's grow through acquisitions. In the core, really, I would say we all felt, and this is a royal we, by the way, because when I say we, it's the management team that's been in place since the IPO. But there's room to improve the operations materially, and that relates to both how we operated the company and also how we dealt with customers. So focus in operations on reliability, which wasn't where it should be and still probably isn't today. And a lot of technology has been deployed in doing that. And then on the customer side, improving the customer experience. Innovation, this is a relatively new word, I'd say, for us, because we truthfully haven't done much that would be externally regarded as innovative. However, I think I have a different view looking from the capital markets is say the capital markets don't pay you for science projects. They pay you for making changes in the business that improve your efficiency or make your customer experience better. So we're going to drive that into the business and say, for example, we're right now a run rate of about $100 million a year of O&M costs coming out of the ops business. And I think we think that potentially could go higher, but that's just grid modernization. It's a complete digitization in the field forces. It's process efficiencies. It's nothing that would get written up in Science Journal. I think a lot of that's innovative in its own way, and you add it up, and $100 million a year is really what drives investors, right? Of O&M, of cash flow cost savings, that. And on the customer side, 2 major changes. One was completely revamp the bill. So we found, surprise, surprise, customers, A, thought they were paying too much, and B, when they got a completely opaque bill, they really thought they were paying too much. So what we did is really completely redesigned the bill, showed people the elements of costs, and implemented an app so that any point in time they could go on and understand how much they're using, what they're paying, where they are at, have they paid their bill, has it gone through or not. And the other thing, and I'll say, and this is exogenous because the government of Ontario also realized that power costs were too high, so they implemented the Fair Hydro program, which is a government-driven program that we implement to reduce the bill to consumers. And those 3 changes, I can tell you, are just unbelievable. And you can guess the order of them, which was most important, but the fact that bills going down, people can see on their bill what that element is and every other element, and that they can check it on a web app. And the customer service, we're not 100% where we need to get to, but it's a very material impact on how people perceive the company. So is that innovation? I think it is. And I think those investments that we make are value driving through the organization. It takes time for them to show up, but they will be, importantly, things that people value for the long term from an investment perspective. The other thing is Avista, I would say, is much more innovative as a company than we are in terms of some of the things they've done. They have an innovative DNA in their core. And one of our objectives as we move towards bringing the companies together is adopting best practices no matter where they are. And I think we can say that if they have innovation DNA that's ahead of where we are, and they've done a lot of things that are very interesting, let's bring that in and learn from that and adopt it quickly. Then just in terms of the financial side of it, growth through M&A is really, that's what it's called now. I think I'm going to call it more, move towards kind of efficiency and capital allocation, because it's not really just M&A for the sake of M&A, but it's really this progressive capital. I think it was Scott that mentioned that before, but capital allocation framework, creating optionality. So we can't be a VC. We can't be taking huge capital risks. We're going to say, okay, let's take small risks, but let's create optionality at every step of the way, and then drive that into operations. M&A where the opportunity is given to us, as it was in Avista, and going forward, just make sure that we continue to adopt best practices throughout the industry, collaboration, and drive true long-term value. Then that will keep our ratings where they need to be for access to capital, and keep it consistent with investors so that they value that income stream that we're delivering.
Great, thanks, Pierre.
Thank you. So I'll give you the European perspective. My first comment would be to fully agree with what Jan said a little bit earlier today. The current framework is not designed to live in a high-tech and renewable environment. Investors are a little bit lost, to say the least, but not only the investors are lost, the players are lost also. And I think this is just the beginning. To continue on what Chris said this morning, we're facing, I don't know if it's a storm or a tsunami or whatever, but we're going to see tremendous changes in the industry and in the energy sector. Today's workshop is based on electrification. Electricity will become the key commodity, the enabler for everything. And I think that requires a full thought on what kind of system do we need, what kind of remuneration, what kind of environment do we need. When I talk about system, for example, the rules of competition, do they normally apply in such a system where nobody can do without it? You will not have the traditional rules of offer and demand. You don't have them already today, and that will disappear more and more. So there is a need for what I would call a full reset. Europe came a couple of months ago with more than 8,000 new pages of legislation, the winter package, which is due to be adopted in the next couple of months. It's not bad. There is a lot of room for new instruments, for flexibility. And what's interesting is that it prepares the seeds for some major changes. My friend Astrid, for example, knows quite well that TSOs in tomorrow's European world will probably disappear. Europe is pushing transmission operators and also distribution operators. By the way, that will be a challenge when you know that we have 9,000, to move ahead towards a kind of US system where we will have ISOs and where you will separate ownership of from the assets from the operation of the assets. The next step is obviously to do what's happening in UK, Ofgem, where you have auctions for new assets. And then what is strange is that you have a regulator, Ofgem, but the other European regulators are doing the same, is putting pressure on the national grid by saying, hey guys, and the distribution grids also, you make too much money, time to bring it down. At the same time also they give higher returns to auction winners. There is no logic there. What is missing in the system, and I will not put all the blame on the regulators. Lawrence, in your different polls, we often see that one of the key challenges is the regulatory environment. It's true, but the regulators can only do with the means that they have received from policymakers. And I think what is missing in tomorrow's world in terms of attractiveness for investment is a right political framework, which should be not bipartisan, but multi-partisan. All the parties should come together and try to agree. You will say Pierre is a dreamer, but I'm just looking at the importance of this asset that is electricity. There is no vision at political level, or it changes every 2 years. There is no, Astrid mentioned stability. I think stability is gone. What is missing is consistency. Stability will not come back anymore because even hard assets like transmission or distribution cannot be considered as a certain asset that will remain at full capacity for 40, 50 years. But there is a need to have consistency. And then what is definitely missing in terms of policy is audacity. Have a vision that goes with the new challenges and the new technologies. There is also a need to change the attitude of the main players, transmission, distribution, and shareholders of these companies. They are all claiming that they want changes, but to some extent, they want nothing to change. When you talk to a lot of investors in infrastructure, especially in T&D, they want nice returns. 4 is a minimum. We prefer to go to 9, 10, early teens, as they say. They want long term, 20, 30 years. You don't have that. And they want also no risk. When your business might disappear in the next 10 years, it's not realistic to talk about no risk. So what we are calling for is to have the major players of the sector, to have the policymakers coming together and give themselves some time to think about a full new framework, not just doing some minor changes that you can sell to the next, until the next election comes on the table, something that will go along for the next 10, 15 years. With a lot of flexibility, with a different approach in terms of return policy, which is not what we have. And I would say, last but not least, what is definitely missing is with more trust. I look at Europe, we have 28 countries within the European community, European Union, maybe 27 if Brexit occurs. I'm still betting on it will not happen. But we don't really have a European Union in terms of energy policy. Of course, Europe came with the European Energy Union and is trying to push it, but you see every country with a different approach. I will remain neutral, but for example, Belgium, my country, decided in 2005 we get rid of nuclear. We are 13 years later, we still have the debate. Are we going to get rid of nuclear? Poland, part of Europe, doesn't want to get rid of coal. How can you then go for 30% renewables, less CO2, when you still fight for coal? So the main issue that we are facing between all these countries, and I think this is something that we are unfortunately facing a little bit everywhere in the world, there is no trust among the main policymakers and among the main players. And this is something that is essential if you look at the next environment for investments.
So, Pierre, just one follow-up question. So if you're advising an investor in that market environment, what do you think they are doing, or what do you think they should do? Do they stick to T&D because they think for somehow or another that's safer? Do they only do one-off assets that have long-term contracts somehow? Or what do you think investors are doing given that?
Well, what we tell them today is look into T&D, but not more than 5 to 7 years. So have a good exit strategy. Look at new technologies, which implies accept risk, and also look at diversification. Jan mentioned also that we should think back about unbundling policies. I was one of the guys writing the unbundling rules in Europe with Astrid and a couple of other people. Well, 20 years later, I think we made a huge mistake. There is a need for unbundling in terms of management, but does it really make sense to go to the extreme the way Europe has been going, and to not allow some companies to invest in grids when they have already some investments in generation? As long as the management is independent, that's the key element for managing grids. So definitely go back together and bring people investing also in new technologies such as storage, for example.
Thank you, John. Actually, through today, a lot of what I was going to say has been cut up a bit, but I'll try to bring it back together. Capital Power is an independent power producer, so we're a little bit mercenary. We'll go wherever we can to put in generation facilities and get paid either on a long-term contract basis or on the basis of it being a merchant market and earning money that way. In fact, we've got 2 of those gas plants that aren't going to get squeezed out of Ontario. It was good to hear that today. But, you know, and I'm going to talk about, you know, the whole element of GHG reduction and decarbonization. And there's some obvious reasons being, we have a significant interest in coal facilities, but we actually go across the range, everything from coal to natural gas to wind to biomass and some solar. So, we're pretty agnostic as to what we'll invest in. But obviously, today the risk in coal is very high and the risk in solar is very, very low. But one of the things that has happened to us as a company is a few years ago when sort of the whole environmental agenda got quite strong in Canada, we're in a province that probably took the most aggressive stand. And we've ended up, over the course of, and this is about 30 months ago, over the course of, about 2 months, we lost 40% of our market cap because of what was happening to our coal plants. Now, things have softened since then, and a lot of that value's come back. But, it made us keenly aware of understanding what's going to happen from a carbon agenda perspective. And also, as we look through that, it's not just what happens on our side of the meter in different jurisdictions, it's what's happening on the other side. So, for example, electrification is huge. And so we've become great studiers of what's happening in different jurisdictions. And I think maybe to bring, you've heard a lot of different comments on Canada and where it's going. And maybe to bring some of that together from a national perspective is, as with a number of the other countries in the world, we made a Paris commitment. And our goals for 2050 on a national basis basically means that we'll be reducing our carbon footprint from today by 90%. And, we have a great start. We're over 80% emission-free from a power perspective, but it means massive, massive electrification. And when it comes to building materials, it means that, in 2050, you're not building out of concrete and steel anymore. You're actually building out of wood. When it comes to natural gas and utilization, 43% of the energy in homes today in Canada is from natural gas. Many of the scenarios have that go to zero. So you've got an entire natural gas infrastructure that could be stranded, depending on how Canada chooses to actually meet its environmental commitments in the longer term. And we've got a lot of things that have happened. Coal is now going to be shut down in the country by 2030 and started from a pretty clean path. And in addition to that, there's different standards that are coming in and standards that are promised. But even with that, generally speaking, in our 2030 goals, we're only getting about halfway there. So there's a whole bunch more that needs to happen for us to even start getting close to it. So what I see from, and bringing it back to the financing side, and very much, very, very similar to Pierre's comments, like there's going to be a dramatic amount of change. And on the electrification side, on the generation side, a lot of changing technology, a lot of capital is going to be lost on that path. I find it interesting. I've come to the conclusion in different things that I've looked at that by the time there's serious penetration in North America for electric vehicles, they won't be plug-in. There'll be something else that deals with the grid problems and with the technical problems. It'll be, you may be getting recharged as you're in a drive-through line at McDonald's. Who knows, but it's likely not going to be charging. So there's going to be a whole bunch of capital stranded from that. But that's just one example of, what'll happen from an investment standpoint. Right now, infrastructure is the darling of investment today. We're coal generators. We have no problem attracting capital, relatively speaking. That's going to be dramatically changed over the next decade. And I think you'll see where, because of the rapid change and stranded capital happening as technology moves forward, I think you'll start seeing financing this whole sector being quite difficult. In fact, I'll just make one comment and then I'll be quiet. The Conference Board of Canada did some work analyzing what exactly does it mean to meet these goals and taking this approach to decarbonization and utilized some of the work done by the Government of Canada. And they came to the conclusion that, for example, in the power generation business, we have to double the investments that we're making. And that started last year, and we were nowhere near that. And when you look at the whole electrification, they made everything kind of work around huge dislocation in different industries. Some are great winners, some are great losers. But they came to the conclusion that where it all fell apart is they couldn't figure out where the capital was going to come from. It's just not, there's just a massive, massive, massive amount of capital that's required to go through electrification. And with the risks, the technology, and so on, it just may be not there. So anyway, that's my 2 cents.
Brian, can I just ask maybe 2 follow-up questions? First, you talk about the IPP nature of their business. You don't talk a lot about retail. There's a lot of debate with investors about is there value in retail, not just as a hedge for wholesale, but this whole concept that was brought up earlier about owning the consumer and that sort of thing. Do you spend a lot of time thinking that could be interesting, or is that not an area of focus?
So I actually spent a part of my career on the retail side. In fact, I had 1 million customers in Ontario. And I can, from personal experience, certainly it helps if you get load from the retail side and so on. But it is a very different and challenging business. And we found and continue to find that the whole element of the consumer is a very, very tough nut to crack. I mean, there's a lot of difference between what people would like to see and what they'd actually pay for. And I think that's continues to be a very significant rub in terms of people just, they would like things to be greener, or they'd like things to be more efficient, or they'd like things to be more convenient, but they're not necessarily prepared to pay for it. And I think that continues to be a challenge.
And then relatedly, on the development side, I think a lot of investors have taken a view that over time, as costs have decreased, so have technological risk around renewables, especially solar and wind. And that, I guess the question for you is, when you think about development, do you assign premiums to renewable assets at this point and saying, hey, I have to get X% ROE over what I do like a gas plant for, or is it in parallel, or how do you think about those issues?
It's actually the other way around, that we put a significant premium on other non-green. If we're building or buying a natural gas plant, we'll put a significant premium on that just because of the environmental risk and issues associated with that. On the renewable side, we're typically, we're building wind farms. We're building a couple as we speak, and both are under long-term contracts, one down in the States and one in Alberta. So we're, from that perspective, you're kind of covered for 15 to 20 years. And the tail risk, you assume that there's technology and other things that you can deploy at that point in time. One of the interesting things about a lot of the renewables that are under long-term contract, and we've actually got 3 contracts in Ontario, is you actually can't do anything. You can't increase the capacity, you can't increase the effectiveness. It's just, we get paid X per megawatt hour generated, can't increase it, can't decrease it, can't move it. If batteries became, very effective in terms of helping move load, our contracts would preclude us from actually doing that without renegotiating them.
Thanks. Tom?
Thanks, John. I'll keep my comments short. Being the final speaker of the day and talking about financing, not making my job easy for myself. But I work in the infrastructure private equity business at Macquarie, so it's a very similar business to what Anthony spoke to on the earlier panel. We make investments in things like electric utilities, other generation assets around the US. And what we do is we take private capital from pension funds, from insurance companies, from sovereign wealth funds, pull that into a fund, and then deploy it. Currently, the funds that I'm involved in, we have investments in 2 electric utilities in the US. Puget in the Pacific Northwest, which John Colella from earlier today, he's getting to know that asset very well. And personally, I'm very involved in CLECO, which is a vertically integrated utility in Louisiana, which we purchased that utility in 2016. So they're the type of assets that we invest in, and this is in the infrastructure asset class, which Anthony talked about. And the thing about infrastructure is we do expect long-term stable cash flows. So a lot about what we were talking about today is more at the, I suppose, at the leading edge of the power industry. And given our proposition to investors is long-term stable cash flows, we need to balance the proposition between this as a growth industry, and I can talk about why we see it as a growth industry, along with the essentially our pitch, which is these are long-term stable cash flows, and you basically know what you're going to get. So when thinking through our investments, a key part of what we think about is how can we, as a manager, unlock value. So how can we work with our management teams? How can we work with the boards? How can we work with our co-owners to unlock value? So we need to identify it and then go ahead and do it. And importantly, the benefits that flow from unlocking that value, we recognise that they need to be shared. So where there is value to be unlocked, firstly it's got to be identified and then done, but then it needs to be shared with certainly the customers, and that's who the regulators are looking out for. Shared with the customers, also shared with the employees and the local community. But importantly, a portion of that value does need to flow up back through the equity structure to our investors who are expecting some form of return. So when we think about our investments, it's the classic risk-reward type equation, and that's an evolving equation. But certainly the electrification of the economy, as well as evolution of the power industry more broadly, provides opportunity on the reward side. So where we see that opportunity come from, it comes from both a growth angle. We can invest further in assets to support a more modern infrastructure within our assets. So there was some debate earlier today around whether investment in assets is a good thing or bad thing. If it makes customer bills go up, then maybe it's not so great. We kind of see it as should be net beneficial to customers. So if we invest in new assets which can improve the overall system, that is beneficial to us because we have increased the size of our investment and the asset base that we earn on. And similarly, it should be beneficial to customers because it should have a net reduction in the overall bills which are paid if it swaps out operating expense for capital investment. So that's basically the framework by which we kind of consider capital investment. And that provides an opportunity to both grow our investment as well as improve the businesses which we own and which we influence typically through our roles on the board. So for those reasons, we certainly see electrification and the evolution of the power industry as very positive for us as infrastructure investments. The challenge for us, and this is what I think us as investors, we need to educate our clients more and work with our management teams, is embracing that change. So actually embracing it and being comfortable with the risk. So if we see the reward as further investment and improving the companies, the risk here is that it may not play out as planned. And if we go into an investment and we're essentially banking some of our returns expecting further investment in technology or improvements to come from technology, and then that doesn't eventuate, we won't hit our base case returns, and then that's going to not be great. But right now, we're not particularly good at assessing that risk, so we don't bake it into our valuation. Our base case valuations tend to be on aspects of say, electric utilities that we're very comfortable with, that we know the management team's very comfortable with, but we don't really take a flyer on any of the new technologies, a lot of which what we've heard about today, or the innovation that we've heard about today. And I think that was perhaps what John mentioned, was talking about in the earlier session, where particularly the public markets aren't good at valuing that, and perhaps the private equity, such as what the business I'm involved in, we're better at valuing it because we take, say, a 10-year view on our investment in these type of businesses. But I'd say we're not there enough, and I've been involved in developing investment theses and business plans for all our companies, and as a base case we certainly don't factor in some of these, and we regard that as upside. So it's incumbent upon us as investors and working with our management teams and educating our clients around what that opportunity is, because it's still regarded as an upside risk rather than part of what we regard as the base case. Thank you.
So, Tom, just relatedly, because Macquarie's invested in water, electric, and gas, just as you guys go to investment committee and think about your firm view, does your firm have a view about the order of risk around those sorts of asset classes? Do they think about them roughly the same, or is it a company by company thing, the way they think about it?
Well, it's certainly company by company and jurisdiction by jurisdiction, but the level of change and innovation in the electric sector or the electric industry is higher than gas and water, and we perceive it to be. But then basically when we think about the investment case, we tend to strip out so going back to what I referred to before, we don't necessarily value the potential upside in the electric industry, which we potentially could, despite recognising it as being there.
Okay, great. Maybe we could open up to questions from the audience if people have questions they'd like to ask. Bob?
Actually, this is a question for you and also for Macquarie. You started. John, question for you also for Macquarie. You started by saying that tech investors have a different view. One way to get a sense of where a sector is going is follow the money. So if you could say a bit more about that view, and then the Macquarie perspective is as you rotate out some of those asset investments, you're also looking at some potentially fairly interesting kind of over-the-top investments. So if you talk about all that, and others please weigh in as well.
Sure, I'll be happy to start on the tech front. So we get a number of tech investors in every so often. We host these dinners for investors. Interestingly, many of them have a view that there is disruption coming to the sector. They don't know what it's going to be, but the fact that it hasn't happened yet or that it's going to cost money is just naivete because they've seen it in every other sector. Truthfully, our experience with a lot of them is they themselves are a little light on detail about both the physics of the grid, but also the regulatory compact about how consumers expect to flip the light switch and have the lights come on as opposed to missing out on service. That said, they have a lot of money to spend. We were talking earlier about Google and Amazon and those sorts of folks. So they're another actor that we see. They're very consumer focused. They don't want to be regulated, but they do want to be around the consumer. They come to see us also. And I think they're all trying to figure out the mousetrap about whether energy is a space they can be in and own the customer like they would like to own it in other parts of their service. And I think it is true. Somebody earlier was talking about data. Credit card companies and people like Amazon have more consumer data than almost anyone else, and they are very good at exploiting it. Now, state by state laws make it difficult in certain states about what you can do with it, and we'll see how that plays out. But if they are given free rein, they're going to have, I think, some opportunities to deploy their capital on the retail side and continue to try and bring in more customers. And remain unregulated, yeah, for sure.
In response to follow the money, I think Brian said it earlier that like the money, the capital, it feels like the capital's already in this sector, and there's a lot of capital chasing fewer deployment opportunities. So, we're seeing asset prices particularly high. If you're looking at a fairly stable utility, the returns you would get in investing on that today is, significantly less than 10%. And that's because there's a large amount of capital chasing relatively few opportunities. So the challenge for us is finding more creative ways of seeking returns, and that could be, for instance, we've thought about playing in different parts of the capital structure, so not just taking straight equity positions, playing in mezzanine or debt kind of investments, as well as we tend to like taking controlling stakes in businesses because it gives us more influence over the direction of the business. But we've thought about taking smaller stakes across a broader range of investments. So it's almost innovation from a financing point of view that we need to find a niche that we can play in that improves our returns from somewhere below 10 to somewhere in the low teens.
Thank you. My name is Lamin Savadogo from Marathon Energy Systems. Throughout the day, people talked about flat demand from all the markets that you talked about. Yet there is a place in the world where the demand is not flat. In fact, it's steep. It's very steep. It's the 100 or 100-pound gorilla that is not in the room. It's Africa, where demand has been growing at amazing rates. Yet it does look like it's on the investment community as represented here. It's on your radar. Maybe Africa is not ready for prime time in people's views, but I wanted to know if you could tell us how Africa is perceived and what it will take for all of you, the investment community, to start paying attention. And you can really speak in blunt terms. Their Tom Kuhn is right here, okay? So he can take the information back to them. There are also success stories as represented by a company here that is a private company operating in Africa and doing very well. And Mr. Amwoka told us that the last president in his country lost the elections because it did not provide power. Those are real factors. So what will it take for you who are involved in chasing the highest rewards? What will it take for you to look at the African continent with a new view? Thank you very much.
So I'll be happy to start because we have bought and sold stuff for clients in Africa. So a couple data points. Investors in Western Europe, Japan, and North America, public investors, probably think that they're getting a total return of about 10%, plus or minus. So that's some form of dividend and some form of growth. And for that, they're relatively happy given the interest rates are 2% or lower in Europe. And so your next leg up is, okay, so what countries have growth? And it's Africa, it's Southeast Asia, and maybe a few other pockets beside that. And they say, okay, so what rate of return am I going to need to deal with either foreign currency risk or different types of sovereign risk, or how am I going to think about it? And what can I sell back to my own investors who are giving me money? A couple of issues tend to come up. One is scale. In Africa, a lot of the investments are somewhat one-off. Eskom hasn't privatized yet, if ever, but you just don't have a lot of what I'll call multi-hundred million to multi-billion-dollar opportunities. Not that that's what the investor would take, but if they're looking for less than a 5% stake and they're looking for liquidity, it's hard to find those sort of investments. So then you're looking at private investors, and AES and others have certainly been investors there. And there's also a lot of work more in Northern Africa, right, about what's going to go on with nuclear or what all might go on. And one of the challenges they have found is that a lot of their investors, and it's gone to some of the theme today, aren't paying them for the incremental perceived risk exposure, be it currency or sovereign, versus the 10% rate of return. And so ultimately they have to ratchet up, and they say, well, maybe if I could get like a 25 or a 30% rate of return, that would be enough to make it appealing to my investors to kind of move me into a different investor class. It is very difficult to do, and the net challenge right now is there hasn't been a consistent enough product, I think, for equity investors to dive into where they feel like it's worth their time and effort to make a run at it, but that could certainly change.
Hey, John, maybe I can jump in on that from a couple of perspectives. First, from the operating side, our company today is by global scale not that big of a company, and we're increasing the scale dramatically through our acquisition in the U.S. But still, one of the biggest issues I think we face is just the amount of management time and bandwidth to do everything we need to do. And so, in looking at today, we have to kind of limit the scope of what we're doing, and that's going to be North America. Over time, as scale grows and our capacity grows, then of course we can look further afield. And I think the other thing, and I'll just put my former banker hat on now, because I think it's something that the industry has to be aware of, is that the industry writ large and investors in the industry, there's been a kind of a global unrepeatable tailwind in the structure of interest rates since roughly 2008, 2009. And that is, of all sectors, has probably, our sector has been one of the biggest beneficiaries of that, as has infrastructure, and that it has made any decision look better from a financial rewards perspective than it otherwise would have looked like in a flat rate environment. Okay, now we face, for the next X years, whatever X is, a rising rate environment, and that's going to do two things. Number one is that's going to make it more challenging, everything else being equal, for investors to realize the type of returns that they've become accustomed to for the last 10 years. And number two is, as that happens, then capital will redeploy, and I think so that you'll have a flow of capital to other opportunities. And I think the challenge and the opportunity for Africa is that if there's growth and there's a perceived de-risking, then that incrementally over time, as that occurs, it's a balancing factor. So, that I think is in Africa's favor, and I think it'll be interesting to see how it goes. And I think challenge for North America, opportunity for other areas.
Yeah, I tend to follow what he says, is that it's essential. Growth is there, but there is a need to provide more information on the de-risking. And what is missing today, we see a change, but it's too slow, is that there is a need for Africa to open more doors to more decentralized projects. If you look into Africa with the traditional technologies, centralized system, you're going to end up with the same problems as for years. If you look into it more in what I would call a last mile approach, how you bring decentralized power to local communities and fund it locally, and then multiply the system in different places, capital will follow also.
So maybe as an operator, I'll make two comments. Just generally as a company policy, what I've said is we're not going anywhere that we're not speaking English and I get my feet wet. So, we're pretty much tied down in North America. But, I'll say in the last couple of years, we did look internationally and considering different places to invest. And one of the things, and we did consider Africa, and one of the things that concerned us, as does a couple of locations in South America, is just personnel risk is a huge issue for us. And we would have great difficulty in going anywhere where we thought that we would, whatever our enterprise was putting people at personal risk, either from a health and safety perspective or from the perspective of just country political risk.
So very quickly, the phrase I used before is basically the mantra to our clients, which is long-term stable cash flows. So the stability of the cash flows in an investment in Africa would be kind of questioned by both our clients and our investment committee. So we would have to demonstrate a regulatory framework, a political framework, a revenue framework by which those cash flows were stable over, say, a 10-year period.
Thanks. I've been spending a fair bit of time in Europe in the last couple of years trying to attract institutions, pension funds into our stock. And I'd have to say, they're really high on North America. And yet I sense, today we had a lot of conversations, and frankly, our European friends are doing a lot of interesting things in this business and innovation. There's been a lot of regulatory reform. But I get the sense that investors in Europe are more comfortable in investing in utilities in North America. So it's telling me something. It's like our regulation in North America has been, it's been changing, but still it's state-based in most cases, provincial-based in Canada. Traditional cost of service is rooted in those concepts. Investors love that stuff. And yes, there's change occurring in the sector, but I think investors are still thinking this is a pretty damn good place to invest for the foreseeable future. They may be getting it wrong. But I'm sensing, and some of it may be interest rates, John, you're right, but Europe's got low interest rates too, right? Probably lower than North America at this point in time. And I was just in see Deutsche Bank Asset Management, and they still have lots of money coming in for, and they love placing it with dividend yields of 4% with some growth in North America. So, I have this concept of more innovation maybe in Europe in the sector, maybe more regulatory change, but yet it's, investors are not putting any value on that. It doesn't appear to me.
Well, I agree, but I would say the returns are higher here in the US. There is more stability to some extent, also on the regulatory framework. And as long as you can keep the lawyers away, European investors are happy.
Basel works in one of the best regulatory regimes going up until maybe 2 years from now. But almost every rec is private. So there's very few opportunities there. The whole deregulation process in Europe has been very challenging for the incumbents. You could argue about whether that was regulatory driven or investment driven or what they did with their money, but we just had the huge deal in Germany 2 weeks ago, again, shifting the deck chairs of something that had just been shifted 2 years before that again shifted what had been done before that. And you have a couple of capital constrained French guys at one level with some challenges. And it is interesting if you're an investor. I do think they find the U.S. Canadian model appealing, if not for nothing else, the stability. Let's see what happens with Brexit, and just might be a good place 2 years from now, but for right now, it's a pretty good rate of return. Okay. Thanks, Lawrence. Thanks to our panel.
So please don't leave your seats yet. I want to call Tom. We're going to do a quick switch in the program. Tom is going to give a few closing remarks.